Okay. All right, so today we're going to talk about capital gains and losses. Generically, capital gains and losses are made from sales of stocks, bonds, mutual funds, houses, and then any other personal assets. So if you sold your couch, other random personal items, those count as well. If you have capital gains in the form of stocks, bonds, and mutual funds, you'll get a 1099-B or what's called a brokerage statement from whatever company you have do your financials. That form will look, I'll show you what the IRS's version of a 1099-B looks like in a little bit. Brokerage statements look, they have all the same information, but they don't look anything like what the IRS's version looks like. And a lot of the brokerage statements also include a 1099 interest and dividends along with the 1099-B. So sometimes it'll be like this big pack that's got like 10, 12 pages. You got to look through and see if they have interest, dividends, or if they have a capital gains. So you'll have to look through that. Unfortunately, I could not find a good example without finding just a general persons that we've done before and blacking stuff out, and I didn't have time to do that. But and then we could also have capital gain distributions. So this is box 2A on the 1099 dividend. That gets reported as a capital gain as well, even though it's on the dividend statement. The other one is if you sold your house for a large gain, you will get a 1099-S either from the bank or your realtor or mortgage lending company or something like that. The stocks, bonds, and mutual funds, those get entered on Schedule D and Forms 8949. So the individual transactions get input on 8949 and the totals get transferred to Schedule D. The capital gain distributions from the 1099 dividend go directly to Schedule D. There's a separate line on Schedule D for that. And sale of your home also starts on 8949 and then gets transferred to Schedule D. So this is what the IRS's version of a 1099-B looks like. The main highlight points is it'll tell you what kind of property is. So if there's 100 shares of Google, Microsoft, whatever, will be listed. The date that you bought the stocks or bonds, the date you sold them, how much you sold them for is proceeds, how much you bought them for is the cost. Most the accrued market discount, if you see anything in there, that's out of scope. So wash sale, that's an adjustment, and we can do wash sales. Most of the time on the brokerage statements that we'll see, there'll just be an adjustments column and it'll say W. And that's a wash sale adjustment, and we can do that. Some of them, well, they all separate if they're short-term or long-term. On this particular form, a box would be checked. Most of the brokerage statements, it would have them separated within the statement. So usually it starts with short-term, so it'll say short-term sales, and then it'll have all the short-term ones, and then the next section will say long-term sales. That's how most brokerage statements are broken out. Some of them will have federal withholding. It's kind of unusual for them to have unless the client requested it, but most people don't, but occasionally, but double check, because somebody might have been forward thinking and did had federal withholding taken out. You also have to check, there's two different types, if the amounts are reported to the IRS or not reported to the IRS. So you'll have to make sure you pick the right one because it makes a difference on which page of the 8949 it goes on. If it's reported, it'll go in section A. If it's not section B, and if it's not on a 1099 at all, it'll be in section C. So the 8949 has 3 sections. And then if there's any of this stuff down here, unrealized profits, losses, aggregate profits from contracts, different things like that, those are all out of scope for us. So if you see anything remotely in this realm here, we cannot do those. So that's the general sections that will be on a brokerage statement. It would be very rare that we'd see this actual form look like this. Most of the time it'd be a brokerage statement. This is the dividend statement. This box here, 2A, total capital gain distribution. That's the only part that's put on Schedule D. If it's dividends or any of these other things, it would go in a different section. This is the only one that's related to capital gains. This is what a 1099-S would look like that you would get from your realtor or bank. It'll say what day that you closed on the house sale, how much you received from the sale, the address of that particular house. Sometimes it'll have the real estate tax, and there are certain versions of the form that will put the cost if you told your broker that to begin with. Otherwise, we'll have to get the cost of when you purchase the home from the taxpayer. So these are the basic items that we need for capital gains and losses. We need to know the sale price, so how much the asset was sold for. Like I mentioned, on any of the 1099s, it'll be reported as either sale price or proceeds. Usually those are the 2 terms they use for sales price. Then we need to know what the cost, or if you're going by accounting terms, they call it basis. Generally, it's the original cost of what you purchased the item for. If it's a stock, bond, or mutual fund, the basis should be reported on the statement. The broker that you go through should have reported it for you. It didn't. 10 years ago, this was not the case, but they've changed that, and so it'd be very unusual for there not to be. It would only be if somebody bought a stock like 40 years ago, there may not be a basis, but in general, there will be. As I mentioned, if they sold a home, you're gonna generally need to ask the taxpayer how much they purchased the house for to begin with. Either have them bring their original purchase statement from when they bought the home. If they sold just like furniture or anything like that, generally we would need some sort of receipt from when they bought that item to use the cost. Otherwise, we had to assume that the cost was 0. This is where we've had a few people get in trouble the last couple of years with the increase in the people selling items on eBay, Amazon, Etsy, things like that. They do have to report those things, but a lot of people don't have the receipts from when they bought whatever item 10, 15 years ago. But in order to have an offsetting cost, we need the documentation. Then the other thing we need to know is the holding period. So short term is if it's 1 year or less. Long term is if you had it for a longer than 1 year. There's some nuance to this when, like, if you inherited something or if you were gifted something. But generally those are out of scope for our purposes. On a 1099-B, both the purchase and sale dates will be shown on the 1099-B. Every once in a while, if there's a whole bunch, it might say various. And there is an option in our tax software to just mark that it's various dates. The sale of a home, the date of the sale will be on the 1099-S, but the date of purchase will need to ask the taxpayer. Any questions so far? So in general, with the way that our program is, they want us, and the way that the software that we have is, we generally need to enter each transaction from a 1099-B or brokerage statement each individually. However, occasionally we get somebody who, every once in a while we have a student do this, where they are practicing their day trading, and so they have several transactions, 50, 100, you know. So in that case, what we would do is we would categorize them by if they're short-term and they're reported to the IRS, short-term, they're not reported to the IRS, long-term, they're reported to the IRS, long-term, not reported to the IRS. We would separate it into 4 sections. And then we'll need to decide, it might be a site-to-site thing. If you do it this way though, you need to, there's a PDF attachment where we'll have to figure out how we're going to get those attached, because you have to attach the brokerage statement to the tax return if you do this bucket system. Or you have to print out this transmittal form, and there's a checkbox that you can check, and then you mail the brokerage statement to Texas. So those are the 2 options if we end up having to do the bucket version. So Dr. Mooney, Anna, and I will kind of discuss this and decide which route will work the best. And we'll probably talk to the site coordinators as well to see what would work best for each particular site as well. But otherwise, generally, if it's less than 10 or 15, enter them each individually. So this is what, when you get into TaxSlayer, this is the first when you click on Schedule D capital gains, this is what will come up. Capital gains and losses, additional capital gains, other capital gains, including carryover, sale of a home, and PDF attachment. So the 1099-B and the brokerage statements and the sale of your personal items would go under capital gains and losses. This additional capital gains, this would be if for some reason you had other capital gain distributions that weren't on your 1099 dividend, you put them there, but that'd be really rare, so don't worry about this one. Other capital gains, we might need to worry about this, because in a little bit I'll talk about losses. This is where you'd put a carryover loss from the year before. And then there's a separate section if they're selling their house. And then this is where, if we need to attach a PDF, attach the brokerage statement as a PDF, this is where you would attach that. Then once you get it, click into the capital gains and losses. This is what you'll see. So you'll click, if it's taxpayer, spouse, or both, you'll type the description. So how many shares of whatever stock. You'll either put the exact date, or you can check here saying that it's various. Same thing with sold, you'll put the dates there or check the box saying that it's various. Then you'll put in the sale price, so that's how much they sold it for, or the proceeds. And then this is where you'll mark if it was reported to the IRS or not, or that you didn't get a 1099 for it. So you need to make sure you mark this correctly because it goes on a different section of the form. The bottom part of the input, you'll put the cost. And then any adjustments. Generally, the only ones that we worry about are, and then the only one that we generally see is this wash sale one, code W. It'll show a W on the form. And then you'll put that amount here. Of these check boxes down here, The only two that we really ever do is the wash sale one, like I mentioned. And then if we're reporting multiple transactions on a single row. So this one, we have to check if we're doing the bucket method that I mentioned before. If there's a whole bunch of transactions, we have to check that box. So the gain or loss from the sale, that's what's reported as taxable or not. So that's why we have to put in the sale price and how much they bought it for, because it's the difference. So if the sale price is more than the cost, then it's a gain. If the cost is more than the sale price, it's a loss. Like I mentioned, generally the cost is reported on 1099-Bs now. If it's not there, we either have to have them go calculate it. We are not going to calculate it. I've done that before when I worked as a CPA in a firm. It takes a long time. You have to look at the different stock sales, if there's dividends, stock splits, different things like that. You have to go through the history of that particular stock based on that. Really long time. So if there's nothing there, have them go back to their financial person or have them do it themselves and figure out what the basis is. If they don't know and they still can't figure it out, we just have to assume that it's zero and they have to pay taxes on the whole amount. Losses, you can't do more than 3,000 and it's 1,500 if you're married filing separate. Because of this, occasionally some people's losses are larger than that. You would have to carry that loss forward to future years. So say this year you had 4,500 as a loss. Next year you'd have to carry over 1,500 of that. And so let's say next year your gain is 3,000. You could take that loss off. So then your gain is only 1,500. So you can only take your loss carryover if you have a gain the next year. And if you don't have a gain that next year, you keep carrying it forward until you can use it. So if they have a gain, generally, if they bring their prior year tax return, there'll be some sort of worksheet saying how much of their loss was carried over. So we'll need to make sure we ask them if they had a loss carryover of capital gains, because we'll need to get that from them and put that in if we didn't do it before. Now, if we did their return the last few years, it'll automatically roll over in our software as a capital loss. So we only need to do it if they're a new taxpayer at our site. Any questions on general capital gains, input, things like that?
Layla?
Yeah.
It's someplace on the, form, and I think it's on the cost when determining the cost basis. And one of the answers is worthless. You know what I'm talking about?
Yep.
Sometimes that's the only choice.
Yeah.
So that's okay. Okay.
Yeah.
I have another question. Where is Anna? Is she in Hawaii?
I wish I was in Hawaii. It's just my background. I don't know. I found it on the
Yeah,
internet.
that backdrop's beautiful. Okay.
Kyla, I also have a question.
Yeah, go ahead.
Okay. When you talked about stock splits, I'm just curious, how do stock splits and dividends affect the amount of the gain or loss?
So it only affects the cost. So say you purchased Apple stock in 1985 and throughout the years, maybe they did a stock split in the mid 90s. When you do a stock split, that means that you end up with either more shares than you had before. So you have to adjust the cost basis because you have more shares than you had before. And then dividends, when those get put out, that subtracts off your basis because they're paying out some of the money already. So
Interesting.
Yeah.
I never knew that those things affected it, and that's really interesting. Okay.
Mhm.
The other thing I have is just a comment.
Mhm.
I had a capital loss in 2018,
Mhm.
and I have not had capital gains because most of my things are in retirement accounts.
Oh.
And but I am able to take 3,000 a year against ordinary income, even in the absence of a gain. And there's some confusing, I had to look at that a long time. There's
Yeah.
some confusing information on the IRS website, at least in my
Mhm.
opinion. You
Yeah.
know, like some places it says, oh, you can only take it to the extent of gains. And then other places it talks about this ordinary income. So uh anyway, I just thought, I think, you know, unless I'm misunderstanding or didn't get it right, but I think I can take, well, and I know I can because the IRS, I had to file amended returns because I forgot to do it. And
Mhm.
they, you know, they gave me my money. So I think that that is right.
Yeah.
So,
Well, certain things you can reclassify as ordinary. Most people don't do that just because the capital gains rate are a lot lower than ordinary rates, because the highest capital gain rate is 15%. They're either 0, 10, or 15%, whereas ordinary rates are 10 all the way up to 39.5. So that's why most people don't reclassify things as ordinary most of the time, but you can.
well, I guess what I mean is I think I can take a $3,000 loss every year, regardless of if, you know, I don't think I have to reclassify anything. I think it's just that
No,
much
as
is
long as you
allowed.
have income, yeah, you can.
Yeah.
Mhm.
Yeah, that's the way it looks.
Yep. Mhm.
Okay.
Any other questions or comments?
Okay, take a lady who is my age, sold her home that she's owned since the 70s,
Mhm.
and moved into an apartment. Now, go over a little bit about the perimeters of what she's faced with. Is it $1 million that she's protected on, or gain?
So it depends. So, um, so if the gain on the house is 250 or less, you don't have to pay any tax at all. There is a separate limit, like you're talking about the million. Um, that you have to fill out a form to see if you qualify for that. And it's a different type. We're not going to talk about it today. And I haven't done it in a really long time, but it's out of scope for our purposes though.
It could be done.
It could
If
be,
the gain is more than 250, it could be done though.
yeah, there is a real estate, um, it's a home, it's called a home equity. Oh, I can't remember off the top of my head. Like I said, I haven't done it in a really long time.
Okay.
Um, but yeah, there's a home equity calculation that you can talk about. Generally, it has to, generally, I think most of the time you have to have had a loan to use that because it's home equity. It's not just the general sale. But if it's just a general sale, the cap limits for if you have to report is 250 or 500,000. And then if it's above that, then you have to report the gain on the sale.
Can a person, and I think they can, I think the answer is yes, count improvements and stuff, cost of improvements over the years, as long
Yep.
as they can prove it?
Mm-hmm. Yep. Yep.
Okay, so
Sure
you could
can.
whittle that down.
Yep.
Yep, okay.
But
Mhm.
so Jack, if I understand it, I would, let's say the sale was $1 million, then I would look at how much did this individual purchase the house for? So let's say it was, 300,000, but then they did some major remodeling of the home.
Mhm.
And you would add that to the cost of the home and subtract it away from the million. And if that number was less than 250,000 and I was filing single, then I wouldn't have to report capital gains. Is that right, Kyla?
Yes.
So,
I mean,
go
in,
ahead.
in your particular case, that would be true. The only time that it's not true is if you sold a house within 2 years prior. So you can only take this exemption every 2 years. So there's some people that move a lot, but they can only take this exemption every 2 years. So let's say they moved and then a year later they moved again. They have to report they have to report the gain from their second house because they would have taken it on their first one. And so they have to wait 2 years to take it again.
Okay.
But yeah, so you take the sale of the home minus the original cost plus any improvements. You can also take, like if she used a realtor to sell the home, she can use their commission fees, other fees, different things like that. She can take those costs as well to subtract off the sale price. So the information that you'll need to put in, you'll need to put how long you owned the house. They want to know how many days it was your main home because this sale of home is just for generally for your main home only, not for like if somebody has 2 houses or something like a vacation house or something. You generally have to pay the whole gain on a vacation house because it's not your main home. And then you do have to check if you use the first time home buyer credit. The other things you need to put in, like I said, the purchase date or purchase price, the date you sold it, the sale price. And if we can't do this part either, but if this was a rental, for instance, you could use depreciation as well. But you can't do that on your personal home. That would only be on a rental, but rentals are out of scope for us as well. So we wouldn't do this for anybody either, but. And then, like I said, there's some adjustments you can put in. So also if she had to get a lawyer involved or if she had to have the home inspected ahead of time or different kinds of insurance or other fees that you had with the seller, you can include those as well. And any other selling expenses, things like that.
So a person could really whittle it down quite a bit if you can include all those expenses, yeah.
Yep. I apologize for the barking. Somebody came to look at our pool, so.
I had a question. If you do improvements, you bought the house in the 70s, you have some improvements that you did in the 80s. Do you change that to 2023 dollars? Like, because you may have spent 5,000 in 1980, but that would be the equivalent of spending much more now.
Sometime, well, it depends on if you got it. You could have gotten it reappraised in the 80s after you did your improvements. So it's called a step up in basis, which accounts for the change in the prices over the years. So you could get it reappraised and have the adjustment based on time. You could do that.
Okay, gotcha. Thanks.
Any other questions on home?
Kyle, I would say that if anyone has had a sale of a home, and let's say that the gain was less than the 250,000, a person might say, why do I even need to report it? Or should I report it? I think it's always best to report it on the tax return because then that becomes your permanent record of when the house was sold. So if there's any other legal things coming out of that, that now becomes permanent record of the sale of a house, because not every home sale will come with, is it a 1099 S?
Yes.
Yeah.
Yeah, not all of them get that.
But if they have their selling contract, it will
Mhm.
have a lot of this information on that. So then it's just finding it and then putting it in the right adjustments box.
Yep.
So Kyla, here's a question.
Mhm.
So can I have a loss? Can I report a loss on the sale of my house or home? And is that in scope?
No, losses are not in scope.
Okay, right.
Um,
Right, thank you.
so things that are out of scope, speaking of out of scope, if we have a sale of assets outside of stocks, bonds, mutual funds, such as stock options, commodities, futures, things like that. Most people coming to our site would not dabble in those types of assets anyway, but we still can't do cryptocurrency, although I think in the next year or two that'll change. If they have cryptocurrency, we can do it as long as they didn't sell anything. So if they just were holding it in their e-wallet, we can still do the return. But if they sold any for US cash, it becomes out of scope at that point. They're starting to report cryptocurrency on 1099s. Occasionally I've seen them. The thing that makes it a little confusing is sometimes people will buy stocks of crypto companies. So sometimes I've seen on some people's where it's hard to determine if they're selling the actual cryptocurrency or if they're just selling the stock of the crypto company. But I think most of the time on the 1099Bs, it's the sale of the crypto company stock. So if you happen to see a 1099 and you see a crypto company on there, just go ahead and do it. Because it's probably a sale of the stock of the crypto company. We can't do like kind of exchange, so that would be like if that's kind of like if you exchange something for something similar. So if like you exchange one car for another car that are really similar, or if you exchange a house with somebody that's really similar, that's a like kind of exchange. We can't do those either. If there's real problems with the cost basis, and the taxpayer can't figure it out and they don't want to use zero, then that's out of our scope as well. And then, like I mentioned, home rentals are out of scope too. So these are some resources. I have them pulled up, so I'll just show you them quickly here. Let's see. Okay. So these are still in draft form. But this is what the 8949 would look like. Like I mentioned, there's different sections on if it's reported to the IRS or not. So there'll be one of these forms if it's short term and the basis was reported. So there could be up to 3 of them if you have all 3 of these situations. And then what will be shown on here is the property, the date acquired, the date sold, how much is sold it for, the cost, any adjustments, and then in this final column is what the gain or loss would be. And so A, B, and C are short term. And then the second page, D, E, and F are long term. So sometimes I've noticed now on brokerage statements, it'll actually say 8949D on brokerage statements sometimes. So then you'll know that you need to say that it was reported to the IRS. And then at the bottom of each one, it has totals for each thing, and these get transferred to Schedule D. So this is Schedule D. Again, this is a draft form. So the boxes from the 8949 will get pulled over here. So the proceeds, cost, adjustment, and gain or loss will get pulled here for each type. This top section short term, the bottom section is long term. And then if they had any carryover, you'd put those there. We wouldn't have any of these, but if they had gain or losses from S corps, estates, or trusts from K1s, that would go here. We wouldn't have those because those are out of scope. It would net the short-term gain or loss, and then it would do the same thing for long-term. This line 13, capital gain distribution, that's where that box 2 from the 1099 dividend shows up. So after the things from the 8949 get pulled over, that amount from the 1099 div would get added to it. And then if you had any carryover from the year before, then that would give you your total net long-term. And then on the second page, both of them get netted together to figure out if you have a gain or loss, and then that gets reported on the 1040. If you're really, really interested, there is a whole, like a 30-page document specifically on selling your home, figuring out how to do your basis adjust, figuring out your cost basis, how much is taxable, things like that. So if you want a nice read, you can read through that if you like. There's another form. This one's even longer. It's 60 some pages, but just general sale and disposition of assets. This goes into great detail on the different types of sales. And then there is an extra special publication that just talks about how to figure out basis of assets. So if any of you want a deep dive read, you can get into those as well. So I put those as references. And then in our 4012 guide, that's where I got most of the information on how to enter the data. So it's all shown in this section in different charts. It also shows the different codes of things that we can do as far as adjustments go. And then it shows a list of if we see any of these adjustment codes out of scope, don't do it. So you can look at those charts as well. And then in our 4491 training guide, there's also a whole section in here, chapter 10 on capital gains, if you want to read up more on some of the different things. And then there's also some examples in here as well. Any questions?
You all have had some great questions. So thank you for asking those. Anything else that you've seen that might be helpful to discuss? And that was a poorly worded question. But I guess, have any of you been confronted with a Schedule B that's had more than 10 entries on it? Or multiple pages of entries?
Yeah, we've had some at Anderson Library that have.
Okay, and then Jim, how do you handle it at your site?
Usually we've entered the whole thing most of the time. I mean, just for the heck of it. So it does take time. It takes time if you do it that way. But
Okay.
So when you enter the whole thing, you enter separately every single page, or you do the
Yeah.
sum of that?
Every single one.
Every pages. Okay.
Right.
Yeah, every item.
Yeah.
So when they bring in long documents, it gets a little scary. So the
Now-
thing, go ahead.
Well, I wondered, I had someone bring a brokerage statement in and they had like 10 or 20
Oh,
different dates that they would
Yeah,
take
that's
out of
right.
this fund and that fund. And I did just add those together.
That is right. I forgot about that, Karen.
You have to take you can't subtract the losses, like if they've got 15 transactions from here and 5 are losses and 10 are gains, you would just combine the 10 as the gain and the 5 as the loss, or can
that's
you negate those out?
Wonderful, wonderful. So when that happens, definitely check with your site coordinator. So Jim, thank you so much, because I know at Anderson Library, you see a lot of retirement income.
Yep.
And so appreciate how, with respect and dignity, you work with your taxpayers there on that. All right, I'm gonna stop the recording. You know the drill. Now the